Hello and welcome to Martin Lucas Investor. My name is Sensei, and you're watching the Morning Forecast Show. We go live every single trading day, 2 hours before the opening bell. We then go over to Martin, who covers the opening bell. But today, Martin won't be live with the opening bell unless he gets back in time. He's got a special stream running right now. I wonder if I can show you exactly that stream. It's quite important stream. He does this once a year, but it's a funny thumbnail, so I thought I should show you this. Let me go over here. This is Martin's stream today. Oh, where did it go? Where did it go? If I go over here, it says upcoming stream. Martin is it's time to get your prostate checked. Get your prostate checked. That's Martin. Follow my lead. So he'll be doing a special stream. He does this once a year to raise awareness. To go while he's at the doctor, he wants other people to start booking their appointments. So yes, it's an important message. If you haven't got yourself checked, if you have got that letter come through, or if you need to go get yourself checked, or everyone should once a year, especially the older you get, please do take this. Health is more important than money, so please do go and get yourself checked. This is not just for prostate, all sorts of checks. The ladies need to go get checked as well. Please don't think that you're immune. This could happen to anyone. And you should go and get checked. But yeah, this is the yearly stream that everyone starts joking around in the comment section in Martin's stream. The first joke has already come in. Let me move myself to the side. Let me see if I can show you this over here. The first joke has come in from DJ Haynes. Let me see if I can bring that on the screen a bit bigger. How do I do that? There it is. Let's hope. I can't zoom in. Anyway, you guys can go over to that stream after this show and leave your jokes and support for Martin while he's going to get checked. I thought I should bring that to your attention. But let's get into what this stream is about. This stream is about US inflation and the GDP release. That's all coming in this show. The time is on the screen, 35 minutes to go. US inflation and GDP. A double whammy we've got for you today. All of this backlog from the US government shutdown is causing a lot of volatility. And on a day where volume is low, on a day where we're one day before the market closes, tomorrow, I think it's reduced hours. I won't be live tomorrow because I'm going with my wife to the midwives tomorrow. So I won't be live tomorrow, but I think it's a half day anyway on the markets. And obviously the day after is Christmas. So I wish everyone a Merry Christmas. But yeah, it's a low, this time of year, that there is low volume. So anything big can have a massive effect on the market. So we're getting US inflation and GDP at a time where order books are thin, at a time where volume is low. This could be quite the release we have today. Also, this is going to answer the question, are we going to get one rate cut in 2026? Are we going to get no rate cuts in 2026? Right now, the forecast from the Federal Reserve is one rate cut. This data could lead them on to having no rate cuts, or it could go the other way and we can assume more rate cuts. Anyway, it's all to do with the data that's coming out in 34 minutes time. XRP is on edge. Are we in a bull market? Are we in a bear market? We'll be discussing all of that in today's show. Thank you for tuning in. Make sure you hit that like button. Make sure you've subscribed. Let's get into today's show. So this is where we'll be looking at the get used to this screen. We've been using this screen quite a while, for quite a while. We're normally about 30 seconds, 1 minute ahead of Bloomberg when we look at the screen, and we normally have that judgment before. So in 35 minutes time, the first place we'll look while Bloomberg is playing in the background will be here, because the data will refresh on in 30 let me put that time on the screen now, in about 33 minutes time, and this is where we will see it. So this is all the data being released today. Core PCE. So PCE, that's actually all about inflation. If you don't know what PCE is, core personal consumption expenditures. It's a way of looking at inflation. It is the Fed's preferred way of looking at inflation. So the Fed, yes, they look at CPI, yes, they look at PPI, but their preferred metric of inflation, the one they look at, the one they want to get down to 2%, the one that they base most of their projections off is PCE, core PCE. And that's what we're getting today. So the Fed's preferred inflation metric is PCE. That's what we're getting today. Alongside that, we're getting GDP. So let me just go through some of these things we're getting. Um, and also in 19 minutes time, we'll get a little ADP employment change average come out as well. That's about the jobs market. So important to look at, but not super, super important. So CPE will be coming out. The consensus we have, and what does the consensus mean? It means what the market's priced in, what the market is ready for, is 2.9%. Previously, we got 2.6%. Above 2.9%, if we start getting to 3%, 3.1, 3.2, that's a real concern, because if inflation is up, the Fed won't cut rates. The jobs market is, yes, it's a little bit bad and it's getting worse, but it's pretty much fine. GDP is looking good. They don't need to cut rates. And if they get inflation higher, there is absolutely no reason why they would cut rates, because they would say actually inflation is still sticky. The market, the economy is brilliant. Jobs are pretty much fine. So let's keep rates where they are right now. That will be the response if we get inflation in 3, 3.1, 3.2. And what does that mean for the market? Well, the market won't like that, because the market likes rate cuts. Rate cuts provide liquidity. If we get CPE, core PCE up above 3%, that's not what we want to see if you are invested in the markets. If you want the markets to crash, then what you want to see is PCE at 3.2%, unemployment very steady, and GDP very strong. So let's go through these one by one. So core PCE, we want to see, if you want to see the market rally, we want to see it at 2.8, 2.7. Current account, I wouldn't worry about too much. It's not important at all. We've got durable goods X defense, durable goods X transportation. Those numbers will come out and have an effect. Then we have GDP. The big number today is GDP, gross domestic product, annualized. We're looking at the annualized Q3 data. This is the final estimate. This is the gross domestic product annualized. As you can see, it's marked in red. It's the most high impact data release in 31 minutes. And why is it so important? Well, it tells us obviously how the economy is doing. And you might say, okay, we want the economy to do really well. We want GDP to be at 3.5%. The consensus, again, look right above my head, is 3.3%. That's what the market's priced in. If it's at 3 point, if every single one comes out of consensus today, the market won't really move. But obviously, little things change. The consensus is rarely right. But everything's based on the consensus. So 3.3% is the consensus for GDP, the most important number coming out today. You might think the higher that number is, the stronger the US economy is, the greater it is for the markets. That's actually not the case. And why is that not the case? Well, because if you get higher GDP, if you get 3.3, if you get 3.4, 3.5, 4%, 3.8%, anything about 3.5% and above, what that's showing is that the Fed are right. The Fed are right with their projections. We've covered the FOMC a couple weeks ago, and the Fed gave their projections for 2026. They said that the economy is going to be super strong, GDP is going to go up, inflation is going to come down, and the jobs market is going to be fine. Therefore, they won't cut rates. It's going to be fine. That's not great for the stock market. The stock market wants liquidity. The stock market wants rate cuts. So how do we get rate cuts? That's the question. How do we get rate cuts, but also making sure the economy doesn't collapse? How we get rate cuts is GDP to not be very strong. We want GDP to be weaker than expected. And if GDP is weaker than expected, it opens the door up for rate cuts. So what we actually want to see is that number slightly lower than the consensus. Because right now we're pricing in no landing. We're not even pricing in a soft landing or a hard landing. We're just pricing in there's absolutely no chance of a recession. We want the Fed to be on their toes. We want the Fed to be worried. That we want the Fed to intervene and put rate cuts and inject the market with liquidity, so our investments go up. Again, that's if you're a market participant in the markets and you want the markets to go up. We're looking at it through that lens today, because that's probably the lens most of us want. We want the markets to go up. Some of us want to crash, and if you want to crash, then what you want to see is GDP super strong. You want to see PCE really high, and you want to see jobs data really strong. But yeah, if you want the markets, if we're looking at it through a lens of we want the markets to go up, we want GDP to be lower than the consensus, so it gives way to rate cuts, because rate cuts inject the market with liquidity. And then obviously we get the gross domestic product index Q3, but the annualized one is more important for us. We get non-defense capital goods, and we get PCE quarter over quarter. So what we'll be looking at mainly is GDP and PCE. PCE is inflation, GDP is the strength of the economy. We're not getting too much jobs data today, but we're getting a little piece in 14 minutes before all of this comes out. So if you have just tuned in, this is an important stream. We want to cover it all live with you. If you please do make sure it takes 1 second. You have hit that like button. I'm waiting for everyone to hit that like button. Have you hit the like button? I know some people still haven't hit the like button, even though I've asked. Just take 1 second, hit the like button. If you haven't subscribed yet, please do subscribe. If you haven't got the newsletter, there is a link in the live chat. It's also the first link in the description. You always get all the information you need to know in the newsletter. Right now, we're running a 1-week free trial. So go and check it out. I'll pin it as well in the live chat. Okay, we're going to talk about XRP as well. I've got my XRP mug. You can go grab it on martynlucasshop.com. But yeah, let's get ready. 27 minutes to go now. Let's go over to our morning forecast newsletter, Tuesday the 23rd of December. Has everyone seen gold? Has everyone seen silver? Were we right or were we right? What was the most bullish? What was I most bullish on over the last 2 years? Gold, silver. I keep banging on about it. Everyone says it's boring. I don't like gold. I don't like silver. I like, I don't know, SBCE or Mullin, or the amount of investments that people were shilling over the last 2 years on this channel, where we weren't very bullish on FFIE, FSR, SPC, even though I actually kind of like SPC, but for the longest time I didn't because of the valuation. Now the valuation is pretty good risk to reward in my opinion. But all of these, and then I kept going on about gold and silver. They went down the drain. Gold and silver, which was the boring investment, is up 130% on the year. 140% silver's up on the year. It's absolutely incredible. We're loving it. But yeah, the risk to reward is actually not looking as good as it was even 6 months ago when we were still bullish on gold and silver. We started looking at silver at $20. We started investing in gold at $1,500 back in 2022, 2023, live on this channel. And this year was the year of the breakout, especially for silver at $30. So absolutely incredible year for silver and gold. So congratulations to all market participants that were buying gold and silver. Here are the top headlines today. Before we go into the PCN GDP report, we're looking at gold hitting 50-year highs. Not 50-year highs. We're looking at the 50th yearly high. It's made 50 all-time highs this year. This is during the Venezuela oil blockade, fueling massive flight to physical safety. So gold is the flight to safety. It's not Bitcoin, it's gold. Coinbase buys the clearing company. They spent about $2 billion on this acquisition. It integrates event contracts in the new Everything Exchange platform. We have looked at Coinbase. We bought Coinbase at $40 in 2023. We've been bullish on Coinbase. We've had trades on Coinbase from $65 up to $350. Right now, I'm not too excited about Coinbase until we come down to maybe close to the $200 level on Coinbase. And if I don't grab it, if I don't catch it, if it runs away, then I let it run away. I don't FOMO. I don't panic sell. That's my philosophy. Don't FOMO. Don't panic sell. Have a plan in place. Be ready for the upside. Be ready for the downside, and you will always win. If you're prepared for both those situations, you won't be emotional, and you'll act on your plan. Price the S&P 500 in gold and silver, says Jerry. Price the S&P 500 in gold and silver. So what would we do there? We would go S&P 500 divided by gold. This is the S&P 500 priced in gold for Jerry. So as you can see, we are at 2020 levels on the S&P 500. So yeah. What does that mean? That means the price of, just need to see which gold it's using here. Yeah, it's using gold, US dollars an ounce, and it's using the S&P 500. So essentially it's saying it's the same value as it was in 2020. So yeah, gold. So the S&P 500 has not outperformed gold over the last 5 years, I think. Oh, we've got a special guest on the show.
At Junaid Jamshed 8868 donated $1.99 through a super chat. Do you see a drop after data comes out?
Do I see a drop after data comes out? No, I don't know. So thank you for the super chat, but it's impossible to say. I mean, look, I don't have a special answer for you. I don't have a crystal ball for you. All I can do for you is provide you with the information, continue to educate you, go through these data releases all the time together so you guys can build up the knowledge for it, give you both scenarios so you're ready for both scenarios, and maybe give you my my thoughts, my personal opinion, my which way I'm looking. However, with data release, it's very hard. I mean, if I knew if it was going to drop or pump, or if I had a special instinct or a crystal ball, then I would be a billionaire because I'll do that every single data release. Go leverage position, go 100x for 1 minute, and do that every single time, and I'll be a millionaire, billionaire, a trillionaire. I'll be the richest person on earth just with maybe 10 data releases if I knew the exact data before, and if I knew the market would drop. So I'm not saying that to be disrespectful to your question. What I'm saying is you're asking the wrong questions here. You need to be understanding the data. You need to be understanding what happens if it goes down, what levels am I buying, what happens if it goes up, what does the data actually mean, what does it mean for 2026, what does it mean for rate cuts, instead of looking at tomorrow and today and the quick trades you can do to make a little bit of money. I think it's more about understanding the markets, controlling your emotion because you're more intelligent with data releases, and then also looking long term and seeing what sort of market are we in right now. And hopefully over time, by watching the show, by being subscribed to the newsletter, you'll make more money because you're more engaged in the markets, understanding the markets a bit more, and you're not trading off emotion. So the S&P 500 from 2020 is up 206%, the 2020 lows, and the gold is up since 2020. Where is the 2020 lows on gold? Somewhere around here was the lows. Yeah, 170. Yeah, they both perform the same essentially. Neither has outperformed each other since 2020, but yeah, at the moment, gold has been catching up. So the S&P 500 has for the last year at least. Gold is up 71%. The S&P 500 is up 17%. So you can see if we go over to the chart again, gold. Sorry, S&P 500, gold. Divided by gold, you're looking at the same valuation gold as the S&P 5 back in 2020. So yeah, the S&P 500 has been massively the gold has been massively outperforming the S&P 500 ever since 2022. I mean, an extent of 40%. So if you've been in the S&P 500 since 2021, essentially, if you sold the S&P 500 in 2021 or the end of 2021, in December of 2021, and you bought gold, you will be 40% higher in your portfolio. But again, who can time the top? Who can time the bottom? We can always look at the top to the bottom. But essentially, since January of 2022, gold has outperformed the S&P 500 by 40%. So if you sold your S&P 500 in January of 2022 and bought gold instead of being you'd be down 40% compared to gold if you were still in the S&P 500. So it'll be way better off in gold over the last couple of years. But that was the answer to your question. Let's go back through the top stories and then get ready again for that big PCE GDP. Big release today. Why? Well, because we've had the US government shutdown. We're playing catch up. We've got two big numbers here. PCE, it's the Fed's preferred metric on inflation. Remember, if inflation stays sticky, if inflation is high, if we're above 3% on inflation, the Fed doesn't need to cut rates. Why is that a problem if we don't cut rates? Well, if we don't cut rates, there's not going to be liquidity injected into the markets, and the markets essentially won't have a reason to go up. So we want PCE to come down. We want inflation to be coming down to its 2% target. We don't want it to be sticky. We don't want to give the Fed an excuse not to cut rates. Right now, there's only one rate cut priced in. After today, if inflation is sticky at 3.1 or 3.2, or if it goes up, what we're looking at is essentially maybe no rate cuts in 2026. And 2026 could look a lot more different than what it is right now. GDP is the second big number. This is probably the most important number getting released today. Again, GDP. How strong is the U.S. government? Sorry, the U.S. economy. You might think the stronger it is, the better it is for the markets. Actually, if it's too strong, again, the Fed don't need to cut rates if it's too strong. So we want GDP to be a little bit weaker than the consensus, and obviously we're going to cover it all together. We're in about 19 minutes time. We've got 4 minutes until the first jobs numbers, but in about 19 minutes time is when we get GDP and PCE. Those are the two numbers we're going to focus on. We've got it all ready for you. So if you have just tuned in, if everyone can just hit that like button and subscribe, that would be absolutely amazing. Do you consider that gold, silver will continue to run? Yes, I do, but at the same time, I do understand that the risk to reward on gold and silver wasn't what it used to be. Wasn't where it was a month ago, wasn't where it was 3 months ago, wasn't where it was one year ago, wasn't where it was 3 years ago. Even 3 months ago, there was a much better risk reward. That risk reward is slowly fading. But me personally, I still think gold is on target to hit 5,000 next year, potentially 10,000 in the next couple of years if the bull market really continues. Silver, $100 by early next year is still a possibility. So I still have bullish targets, but also my average price is much lower, so I can afford for it to go down, and there will be corrections in the market, and people will get scared buying in now and seeing the market go down. They will sell. That will cause liquidations. It will go down lower. So there is a certain the risk to reward on gold and silver isn't what it used to be, but I am still bullish if that's the question. I am still thinking. What are the chances of a Santa rally? Well, we are. What? How many days do we have left? Today and tomorrow. It all depends on Santa rally. Depends on PC and GDP. So we'll find out if there's going to be a Santa rally in 16 minutes time. Almost missed this. Thanks, Sensei, for covering these data releases. Clay Scott, thank you so much. Yeah, people go, data, it's boring. Why do we care about data? I just want to make money. What's the next 100x stock? What's the next 100x crypto? But when you understand data releases, when you watch data releases, you can build a picture of where we're going in the future. You can build up your knowledge of what they mean. A lot more knowledgeable, a lot more profitable. In my opinion. Again, not financial advice. Please go do your own research. And all of that. Silver hits $70. Is it just hit 70? Oh my god, we've hit 70 on silver. It was literally yesterday where I was saying we're breaking out of $35. We're breaking out of $35. This is where we're gonna go to $75, and we've just broken out of $70. Congratulations. $70 on silver. Congratulations, everyone. Silver has hit $70 an ounce for the first time ever in history. We have hit our first target, which was $70. Congratulations. Our first target has been hit. Our main target is coming up at around $75, and then it's on to $100. But yeah, our first mini target's been hit at $70. The main target's between 73 and 75. The next target on silver is $100 plus. So here we go. That is very exciting to see. 1.6% up for silver. Gold has also broken out into all-time highs today, closing in on $5,000 an ounce. Let's get ready for PC. So let me just give you some more information. We've just got released of ADP employment numbers. They're coming out now. Again, it's not the most important thing, but are they coming out? Are they not? Let's refresh this. I don't know if they are or not. No, nothing has come out for ADP. Yeah, it's 15 minutes time for PCE, all about inflation. 15 minutes time for GDP, all about the economy. Two big numbers that will determine if we have a Santa rally or not. One big thing today is today's final Q3 economic data will determine if the US economy has transitioned into a permanent no landing cycle. This is important. You must have heard of soft landing. You must have heard of hard landing. A hard landing is what the Fed was trying to avoid, which is a severe recession. A soft landing is maybe a mini recession, but the economy's fine. A no landing is something that no one really expected. No landing is business as usual. The unemployment's not really going to go up. Inflation's not going to be too big of an issue. The economy's going to be very, very strong, and we don't have to worry about any landing. There is no landing scenario. So now that's the sentiment going into this. The question that we want answered in 13 minutes time is: has the US economy transitioned into a permanent no landing cycle? And if it has, well, no rate cuts are needed. I'll explain to you again all the numbers and what we're looking for through the lens of an investor in the market right now who wants it to go up. We can look at it through the lens of someone who wants the market crash, and that would be we want inflation to be high, we want the economy to be strong, and we want jobs to be very strong as well. And then in that regard, the market doesn't really have a reason to go up. If we're looking at it through a lens of someone who wants the market to continue to go up, it's probably through the lens of we want more rate cuts, and that would be inflation to be so PCE numbers to be down, GDP to be down compared to consensus, and jobs and unemployment to be up to a certain extent. So, with GDP growth projected at 3.3% and core PCE at 2.9%, the Federal Reserve faces a resilient economy. If it's resilient, that prevents near-term rate cuts. If the economy is resilient, if everything's brilliant, if the economy is fine and GDP is great and inflation is down and not sticky and jobs data is perfect, well, they've got an amazing economy. Why would they bring interest rates down? They don't need to. The economy is in perfect shape. No need to bring interest rates down. So that's in the case if we get a resilient economy. However, this combination of strong output and persistent inflation suggests a higher structural cost of capital in 2026. Meanwhile, don't forget about the Bank of Japan. We haven't just brushed over that story. I did say it's not going to crash. I did say we're going to continue to go up. I did say it's very unlikely to go down because they want a controlled carry trade unwind and they're not going to give too much away. Um, but it's still an important story and it's still something we need to keep an eye on. So, meanwhile, the Bank of Japan rate increase to 0.75% heightens the sensitivity of the yen carry trade. Last week we covered it. We were live for 8 hours. If you enjoyed it, please hit the like button and support the show. But yeah, we were live for about not 8 hours. We're live for 9 hours through the night, from 10:30 p.m. to 8:30 a.m. UK time. That's how long I was live. And we covered it because it was so important. So go back and watch the stream, or go back and watch the look at the cheat sheet on the newsletter. If you haven't got the newsletter yet, it is over here. Oh, Vocal, thank you for the jobs numbers. They're not too important, but thank you for them. So meanwhile, the Bank of Japan rate increase to 0.75, so they did increase rates, heightens the sensitivity of the yen carry trade to US data surprises. A robust print today removes the Fed put by validating a restrictive policy stance. Consequently, investors face a dual threat of elevated borrowing costs and potential global liquidity drains. Right now, the stock market's going into a greed phase. That means we could continue the bullish momentum. Cryptocurrencies are still fearful. The number that matters today is gold breaking through all-time highs. Let me go down to the story down here. If you haven't got this newsletter yet, every single day, the 5 things you need to know, the 5 top stories, the deep dive, all of that you get as part of the newsletter. There's so many more perks. I'll just flash them on the screen right now. You can see over here, full access to the market headlines, ad-free experience, my thoughts, chart of the day, event cheat sheets. You got that with the FOMC. You got that with the Japan rate hike. Deep dive research, XRP weekly newsletter, one-on-one DM access with me, portfolio insights app coming soon. You got the chart training course and the budget plan and debt planner planned releases on the 2nd of January. So that's literally a week's time. So you can get access to all of that. If you haven't got it yet, go and grab the newsletter right now. There is a free plan as well. There's no excuse not to have the newsletter. There's a free trial, so you can go check out all of those. You can get all of those as part of the premium plan. There is a 1-week free trial, but there's also just a free plan where you can at least get a newsletter every day with the top headlines. So let me go over to deep dive. Navigating the Q3 GDP final and GDP final and the PC convergence. The final trading week of 2025. We're in the final trading week, actually about 1 day left of trading. Opens with a high stakes concentration of economic data that will dictate the market trajectory heading into the new year. Happening in 8 minutes time. Have those numbers come out yet? 11.5, previous was 16. Okay, that's very close to consensus. So I think the market's still going to be waiting. We just got some jobs number released, but they're not too important. What we're waiting for. The biggest number today is GDP. The second biggest number is PCE. GDP is economy. PCE is inflation. That's coming out in 9 minutes. We've got Bloomberg on standby here. So what I'm going to do on Bloomberg, you guys can always do this on this stream as well. So make sure you've pressed the live button here. But not only have you hit the live button, if you want to be up to date, you press the live button and also go over to settings over here. There's a cogs button over here on settings. You can do this on your browser or your TV. Settings, press playback speed, press 4 times, even though you're or 2 times, even though you're live. If you press 2 times, it will bring you 15 seconds more forward. It's a little hack in YouTube. You press live first, make sure everyone's live. And then you go to the cogs, press 2x, you go forward about 15 seconds, and then you're literally 1 second behind me. And so it's always worth doing that on data releases. These are the numbers we're covering. PCE is the Fed's preferred metric of inflation. So we want inflation down, so it gives them an excuse to cut rates. We also want the economy to be a little bit less strong, because if the economy is very strong, there's no need to cut rates. We want it to be a little bit less than consensus. So the two numbers I'm looking at is GDP, which is coming in at 3.3%. That's annualized Q3 GDP 3.3. We want it to be a little bit lower. And then the next biggest number I'm looking at, or pretty much as important, is PC, core PC, quarter over quarter. We're looking at 2.9%. We want that to be lower, 2.7%, 2.6%. And also, I think we're getting, yeah, those are the two big numbers. Okay, back to our newsletter. So, final trading week. Today, December the 23rd, the Bureau of Economic Analysts provides the final scorecard for third quarter of 2025, releasing the final version of both Q3 gross domestic product and Q3 personal PCE. The core narrative has shifted towards a no landing scenario. And what does that mean? That's an environment where robust growth, that's what we're forecasting, very robust growth, GDP through the roof, 3.3%, and sticky inflation, maybe 2.9%, prevent the Federal Reserve from pivoting to rate cuts. We want rate cuts. Remember, we're looking at this through a lens of someone who wants the market to go up. We want rate cuts because that allows liquidity to flow into the market. If we continue with high growth and sticky inflation, the Fed won't cut rates. Remember, we've covered the FOMC. Their official guidelines, or their official dot plot, is suggesting one rate cut in 2026. We might get no rate cuts if this data is really good. Or if the data, if GDP is slightly lower, inflation's down, unemployment goes up a little bit, we might get more rate cuts. And remember, everyone's like, oh, don't worry, Jerome Powell's going to be off. We're going to have Hassett in, and he's going to cut rates. It's not up to him. He's one vote. There's a whole committee. His job is to try and convince everyone. Is he going to manage to do that? Well, I don't think so. So even it doesn't matter who the Fed chairman is. There's a whole committee out there. We'll talk about that further afterwards. But anyway, against the backdrop of Japan's recent hike to 0.75%, these numbers will determine if the US economy is merely cooling or remaining dangerously overheated. I'll come back to that chart in a second. So the key drivers and analysis. I'm not going to go through the whole deep dive and the chart, because remember, this is reserved for our premium members, but we do want to go through a little bit of it. Number one is the resilience of the US growth, GDP, and the no landing reality. So the final revision for Q3 of 2025 GDP arrives today in 4 minutes and 51 seconds. With the market consensus firmly set at 3.3%, this represents a slight deceleration from the 3.8% record in the previous period, but remains remarkably strong given the current interest rate environment. Interest rates are high, and the economy is booming. You might think that's amazing, but it means, why would they cut interest rates? And if there's no interest rate cuts, how there's not enough liquidity to keep the market going at this rate. So from the previous period, but remains remarkably strong given the current interest rate environment. Sophisticated investors are currently weighing this as against the Atlanta Fed now the Fed GDP now model, which has consistently signaled a hotter expansion, potentially reaching 3.5%. If the data confirms a growth rate of 3.3% or higher, it solidifies the no landing thesis. In this scenario, the economy continues to expand at a rate that suggests the Federal Reserve's restrictive policy has not yet fully dampened demand. Real GDP, which measures economic output adjusted for inflation, remains the primary focus. If this figure holds steady, it confirms that the US economic volume is expanding in real terms, providing the Fed with justification for higher for longer interest rate stance well into 2026. So that's GDP. If GDP comes out as strong as forecasted, stronger than forecasted, we're looking at a no landing scenario. We're looking at a higher for longer, control inflation. We don't need to do rate cuts. The market might not like that. Then we've got PC. So we've got two big massive releases today. If you have just tuned in, we're covering live PC and live GDP. This is the two biggest numbers, two big numbers coming out on today. The reason for two big numbers coming out is because of the government shutdown. So a lot of data coming out today. It's inflation, it's PCE. Inflation and PCE is the Fed's preferred metric of actually looking at inflation. So it's exactly what the Fed look at. GDP is also what they've been forecasting. So this is what we're looking at today. Two big releases. This will determine if we have a Santa rally or not. This could determine how many rate cuts we get next year. Right now, only forecasted to have one from the Federal Reserve. So yeah, we're gonna digest all this information. So even after the release, stay with me so we can digest it. If I can just ask everyone to hit the like button, subscribe. If you haven't got the newsletter yet, you can get all this information you're looking at now, plus the daily newsletter, plus the training course, plus the debt planner, financial planner, plus the deep dives, no ads. You can get all of that with a 1 week free trial. There's also a free plan at the moment as well. There's also a 1 week free trial for the premium plan. The link is in the live chat right now. Make sure you go and grab it. It's also the first link in the description if you want to do it later. The market expects, yeah, we've read that. Have we read all of that? So yeah, number two is the PC. Today's release includes final revisions for Q3 personal consumption expenditures. The Federal Reserve prefers inflation. The Federal Reserve's preferred inflation gauge. This data covers July through to September period and serves to confirm whether price pressures were more entrenched during summer months than initially estimated. Unlike CPI, which uses a fixed basket, PCE tracks actual business sales and accounts for substitution effects, where customers move to lower cost goods as prices rise. So that's why the Fed prefers it, gives them a bit more data. The market consensus is for core to land about 2.9%. So that's where we're looking over here. If I go down here, we're looking at core PC. This is where we're going to be looking. So right above me, that's the consensus, 2.9%. We want that to be lower. We want that number to be 2.7, 2.6. The next big number we're going to be looking at is 3.3%, right above my head. That's GDP. We want that to be lower as well. So we want the numbers to be a bit lower. Let me finish reading this. We've got 50 seconds to go. So the market expects it to land at 2.9%. While this is a step down from previous highs, it remains nearly a full percentage point above the Fed's 2% target. Institutions are currently positioning for sticky inflation. If the final Q3 revision ticks upwards of 3% or higher, it suggests a structural floor has broken. So let me just show you this chart. In 30 seconds, we're getting the release. GDP, these are the two numbers I'm focused on. GDP Q3, the consensus is 3.3%. We want it to be lower if you want the market to go up. If you want the market to crash, you want it to be 3.5% and higher. If you want it lower, you want it 2.8%. Core PCE, we're expecting 2.9%. If it's lower than 2.9%, 2.7, 2.6, that means they don't have to keep rates as high as they are. Now we're going to go over to Bloomberg as they bring this information. Thank you for tuning in with us. Let me go over to our breaking news.
This morning, we are seeing markets relatively muted as we head into the Christmas holiday. Matt tells me that you have to make sure we're in the middle of the holiday season. The
GDP is 4.3%. Oh my God, it's super strong.
We are awaiting GDP data this
4.3%.
Day of data.
Wow, wow, wow.
And goes home
PC is as expected. Not good
this data is
for the market.
Stale. Remember, we didn't get it in time because of the longest government shutdown in history. And actually what we're getting, to Matt, as you can see his reaction here, a massive upside surprise. Prior was 3.8%. Their survey was 3.3%. GDP comes in at 4.3% this morning. Matt, that is an uptick not many people were expecting.
Yeah, very interesting. I'm going to have to break it out with the ECAN function on the Bloomberg. ECAN Go is probably the best way to look at this kind of economic data. But I initially moaned a little bit because durable goods came in so much worse than expected at a drop of 2.2% and then a huge jump in GDP at 4.3%. I don't know how much is going to change the rate cut calculus. We'll have to take a look at WIRP Go on the terminal to figure that out. But in terms of what traders are doing right now, if you look at the front end of the curve on the 2-year, you saw a big spike up to 350, 351 in yields, and we're still there. So selling the front end of the curve, driving the yield higher.
It's a very difficult one. I'm not going to say the market's going to crash. I'm not going to say we're going to listen to some analysis here, but essentially, inflation is where it's expected, so rates are probably going to stay high. GDP, is the growth of the economy, is super, super strong, so they don't need to cut rates. But it is good to see the economy strong. We don't want to see the economy very weak. So it's a very weird situation we're in. Let's continue with the analysis.
This GDP number rising 4.3% for the third quarter.
There's a lot of action in the rearview mirror, isn't there? I think part of what it does is make you wonder why the Federal Reserve felt the need to buy 3/4 percentage worth of insurance by cutting rates in September. But that was more about employment. What it does is worsen the disconnect we're having between our view of aggregate demand growing at such a rapid rate and employment, which is pretty sluggish.
Do you think that given this information is so stale, it's not going to make a difference? Or do you think Fed officials will look at this and take this information on with them as they consider and recalibrate what they should do in terms of interest rates in January?
Well, the important point you made was Fed officials. Remember, they're pretty divided. That it was a close call in
This is
terms
very
of the
interesting. Let's
overall
listen in.
19 FOMC participants about the last rate cut. That means that almost half of them can look at this data point and say, why exactly were we doing what we were doing? So I think it does matter. And what it does is just heighten the really split within Federal Reserve officialdom.
Hey, Vince, I'm talking with my buddy Joe Brusuelas. He's an economist down in Austin at RSM. And he sees a decoupling between the strong growth numbers that we're seeing, strong real final private demand, and weak hiring as AI, eats up jobs, and maybe we get robotics replacing people as well, longer term. What can cutting rates do for that kind of slowdown in hiring? I mean, if AI is taking jobs, even if you bring rates down 50, 75 basis points, is it going to matter?
Well, you do a little foaming in the runway. The Fed bought insurance. You're exactly right. And the question is, how expensive is that insurance? And the cost of it is that it'll be a little longer to get for them to the goal of 2% inflation next year. Now, if you're facing this enormous supply headwind on output, on rather labor, and headwind on labor and tailwind for demand, there's not a lot that the overnight federal funds rate can do, and I think you are right.
Is 2% truly the Fed's target? Because it doesn't look like they take that very seriously, since we're 50% above it. I mean, CPI, I guess you could say, came in lighter than that in the last reading, but there was so much noise, it might as well be at 3.
Well, they never admit that. You don't give up on your goal when you're far away from it. So that's why Chair Powell vigorously defends 2% and denies any idea that they've changed their goal. I think 2% is a long-run aspiration, and what we've seen over the last 3 months in particular is that they're willing to put off that achievement to buy a little more insurance.
When it comes to this GDP data we just got, I'm already getting a lot of messages from viewers, Vincent, who are talking about the fact that if it's possible that CPI was inaccurate, do you think that it's possible this GDP data also has some inaccuracies in it as well?
The answer to the question, are there problems with government statistics, is always yes. And in this particular case, if we're not confident about prices, that they may be softer in measurement than they actually are, then real activity is going to be stronger because you're dividing nominal activity, which you're
Okay, stay with me for analysis coming up.
A mismeasured price level. So I think there was always an upside tail risk to this GDP print, it turned out to be even further upside.
I wonder what you make
Yeah,
of
we're
policy
crashing
that
now. It
seems,
wasn't good. We're crashing.
Stimulative in the new year, right? We've got the tax refunds coming from the one big beautiful bill. We're dumping tens of billions of dollars out of helicopters on farmers in the Midwest because the Chinese aren't buying soybeans. And now President Trump wants to send, I guess, some kind of warrior dividend to soldiers.
Tariff dividend, too.
As well as a tariff dividend to most American people, while tariffs are pushing prices higher. Does that set us up for a bad inflation picture and the Fed cutting rates, obviously, a bad inflation picture in 2026?
I do believe that tariffs ultimately pass through to consumer prices. And two things have happened. One is we haven't seen all the pass through of the increase in tariffs we've already gotten, and that.
Okay, so we did the analysis before. I'm going to just give you an update. I'm going to continue to listen in. Essentially, what we've got here is the economy, amazing. As I said, you think because the economy is, you want the economy to be really strong, but we've got a shock number come out of GDP, 1 whole percentage point higher than expected. PCE was at expectation. We wanted the opposite. We wanted GDP to be slightly lower than expected and PCE to be lower than expected. What we got was PCE as expected and GDP higher than expected. So it's just showing we've got a really strong economy. What's the need to cut rates? It looks like it's going to be higher for longer.
To foster maximum employment and stable prices in an environment in which, you're not happy with inflation. It's not at its goal of 2%, but it's a lot closer to 2% than it was previously. It weighs deviations on the employment mandate.
If you guys can please hit the like button and subscribe. If you haven't got the newsletter yet, it's the link in the live chat. Go grab the newsletter. I'll be doing a full piece on this. As always, every day you get a newsletter. So go grab it. All the information was there for you. I told you exactly what's going to happen. So go or exactly what could happen once those data gets released. So go and grab that newsletter while you can. It's a 1-week free trial and there's a free plan. It's live in the chat. Let's listen into this a bit more. I've got some analysis and then I've got a special broadcast about how to make money during this AI bubble.
Time and only in passing for a long stretch before 2020, inflation was below the Federal Reserve.
It's not brilliant news.
A range makes sense.
I don't want anyone to be left behind. Someone's just asked if this is good news, why sell off then? Because it's good news for the economy, but the economy is not the stock market. The economy is not the stock market. The stock market wants liquidity. The stock market wants cash. The stock market wants injections. You don't get that when the economy is strong. If the economy is strong, they can keep rates up because it's showing that it doesn't have an effect on the economy. The rates can stay higher, combat inflation, and then you won't get that liquidity in the market. So there is still growth in the market. AI, it's good to see the economy up, but what the market was hoping for was potentially not as strong GDP, so you can get those rate cuts. Right now, the market is now looking at it and saying, actually, there is a very good chance we only get one rate cut because the economy is so strong.
Landies are back, but I'm looking at 417 on the 10-year and like 70 points on the 2s, 10s. It doesn't look that bad to me. Do you think yields are going to go higher?
That's always a deep frustration, right? I come from a family in which we all worry about the federal debt and the untethered path for the deficits. We all worry about central bank independence, what's going to happen as the Federal Reserve changes next year. But the fact is, you don't really see it much in inflation and inflation expectations. Markets aren't really pricing in a lot of worries. I think we're in an environment in which employment is close to maximum, inflation is not that far away from the long run goal, and so we're pretty much priced for an economy that's performing well. We haven't been stressed. And what you worry about, what I worry about, is exactly what will happen when we're stressed. And bond markets aren't particularly good at pricing in an unknown future stress.
Vincent, thank you so much for your time this morning. Vincent Reinhart of BNY Investments. Let's get you an update on stories we're watching elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, Anne-Marie. President Trump says the U.S. Navy will build a new Trump-class battleship. He says they could build as many as 25 as part.
Okay, so for anyone who's just tuned in or doesn't know what's going on, we've just got two big numbers, PCE and GDP. We were looking at, so if I show you exactly the number release, if I get rid of that on the screen for a second, we've got the two numbers we're looking at was PCE. This is this number up here, right above my head, 2.9%. That was the consensus. That's what the market priced in. We were hoping inflation will be less than the market priced in, and then if you get less, if you're close to that 2% target, or if we're lower than the consensus, that would allow the Fed to cut rates, inject some liquidity into the markets. We didn't get that. We got GDP. We got core PCE, which, remember, it's an inflation gauge, and it's also the Federal Reserve's preferred inflation gauge, at consensus. So not lower than expected, not higher than expected. If it was higher, it would be worse. If it was lower, it would be better for the markets because we're closer to our inflation goal. They can cut rates, but we didn't get that. 2.9% was 2.9%. Rates should stay high to control inflation. Then if you scroll down to the biggest number, the biggest high impact story today was GDP. GDP consensus was 3.3%. What we actually got, so the market price in 3.3%, what we actually got was 4.3%, a whole percentage higher than expected. What does that show? Well, it's great for the economy. It shows that the markets are strong. It shows that the economy is super strong, which is, yeah, to an extent, it's okay for the stock market. It's good for the stock market. You don't want to see us in a recession. But ultimately, if you wanted rate cuts, which is a big driving force in the stock market right now, you would want that to be closer to 3.3%, if anything, actually under 3.3%. Why? Well, because let's just go back to 2 weeks ago at the FOMC. We got something that we only get every quarter, and it was their projections going forward. So the projections for 2026. Those projections from Jerome Powell and the Federal Reserve was strong GDP, strong economy, inflation coming down slightly, and unemployment staying in check. What does that mean? Well, it means everything's perfect, no rate cuts. And today it's confirmed that the economy is stronger, inflation is, well, it's not come down, but it's not gone up. No rate cuts. So if you're thinking that we're going to get rate cuts after rate cuts after rate cuts, it's not happening, especially based off this information we got today. So what is the positive of today? If the economy is growing at 4.4%, it means consumers are spending and businesses are investing. For companies, that translates directly into their top line. So their operating leverage, if a company has fixed costs, every extra dollar of revenue generated by a booming economy drops straight to the bottom line. So businesses are going to make more money. That's why we're not going to see a massive, massive crash in the stock market. Yes, we've got a big move towards the downside, but we are coming back up. So a strong economy is good for stocks. It's not good for rate cuts, which is one driving force of the stock market, but it is good for companies that have fixed costs. What we might be looking at now is a rotation. So the sector rotation would be in high growth environments. So in the market might go up even if a big tech stalls. Capital often flows into cyclicals, industrials, energy, materials. So what we might see now is less Mag 7 growth and more industrial energy growth. Thank you for the special guest. Here we go.
Marty donated £2 through a super chat. Markets don't know how to take it. Not much movement.
Thank you very much for that. Markets don't know how to take it. It's not much movement. Yeah, it's a surprise because on the one hand, brilliant, we've got a strong economy. Great for companies. But on the other hand, the big driving force of the stock market in 2025 was rate cuts. When are we going to get the next rate cut? We're going to get rate cuts next. The Fed is too high with their rate cuts. Now, 2026 is going to be different. The story is not always going to be about rate cuts. It's going to be about AI. It's going to be about growth. It's going to be about the economy. It's going to be about investment. And if we don't get all of those things, we're not getting rate cuts. So we will, at that point, the risk is a crash in the sense if AI doesn't live up to what it's supposed to be. So the markets are shifting just in time for 2026. 2025 was all about rate cuts. When are we going to get the next rate cut? or we're going to get rate cuts, so we should buy the market. The market's going up, rate cuts, plus AI. That was also a driving force. But 2026 is going to be different. Forget about rate cuts. Forget about what you're used to now, which is a rate cut every other meeting. Just like we saw in 2024 or the end of 2025. It's not going to be like that anymore. It's going to be, are we going to get one rate cut? Are we going to get no rate cuts? Or are we going to get 2 rate cuts in 2026? The story is not going to be rate cut after rate cut. That's not going to be the driving force. It could be the strength of the economy. So it's very complicated. It's not just a one size fits all. We can't just say, okay, the economy is very strong. That means the market's going to come down. It's not that simple. If the economy is strong, it's good for specific stocks. But the negative force is the discount trap. So stocks are valued based on present value or their future cash flows. To calculate that, analysts use a discount rate, which is heavily tied to the 10-year Treasury yield. When GDP is a massive 4.4%, bond yields surge because the market realizes rate cuts are off the table. As that discount goes up, the present value of future earnings goes down. So now we need to think about the bond market. There's a lot to think about here. And then you go over to something like the 10-year bond yield. So you might think bonds are boring and you're going to tune out because we're now going to talk about bonds. Don't tune out because bonds are important. You have to look at the 10-year bond. So if we go over to bonds, 10-year, let's go over to the US market. What was it? 10. What's the ticker symbol for a 10-year bond? Oh, US 10-year. US 10-year bonds are now up another 0.31%. Why are they up? Well, because they're not pricing in rate cuts. You would think the bond yield would be going down over the last year because we've had rate cuts, but no, that's not been the price. And now that we've got confirmation that there's going to be no more rate cuts, what we're essentially probably going to see is the 10-year bond yield stay up at 4.178%. That's the highest, or that's near the highs of since 2006. So we are looking at very, very high US bond yield. And what does that mean? Why are we talking about bonds? Well, forget about the short-term yields. Forget about the 1 year, 2 year. That doesn't really matter. If you're looking at mortgages, if you're looking at investors, you look at the 10-year. If the 10-year is going up based off this, because we're not expecting any more rate cuts, investors will look at this and say, actually, like Martyn is, I get 4.178% investing in something very safe, US government bonds. The US government's paying me, very, very safe investment. And I take no risk. I don't have to worry about the stock market going up and down. And I'm getting 4.18%. Do I really want to risk my money so I can earn another 2 or 3% in the stock market when we're at such a volatile time? And then also you look at your mortgage and you think rate cuts are going to bring your mortgage price down. Actually, if we get rate cuts too fast, too quickly, then what you actually have is a 10-year not coming down. And that's what your mortgage is based off. This figure here, this is closer to your mortgage rate rather than the close to 2% we are on the shorter term. So if we're not expecting rate cuts and the 10-year bond is going up, we're now up 0.36% today, it becomes quite a compelling investment. Bonds become quite a compelling investment in this market. So when GDP is massive 4.4%, so we've got economy really strong, bond yields surge because the market realizes rate cuts are off the table. So no more rate cuts, bonds can start going up. As that discount rate goes up, the present value of future earnings goes down. Valuation compression. This is why growth stocks like AI and tech often struggle when an economy is too strong. Even if their earnings are good, the market is no longer willing to pay a premium multiple for those earnings because they get a safe 4.5 or 5% return just for holding a government bond. And that's the risk we're falling into now. With the data we just got released today, yes, it's great for the economy. Yes, it might mean that companies make more money. However, it means we're not getting rate cuts in 2026. And if you don't get rate cuts, the bonds can go up in price, and bonds are a very safe investment. And people will start looking at their portfolios. I've made a lot of money in 2025, 2024. The market is on edge. Are we in a bubble? Is there a carry trade? I'm actually going to flee to the bond market. The bond market's going up. I can earn an easy 4.5%. Maybe that goes up to 4.6, 4.75% over the next few months. And then there's only a 2-3% difference between investing in the S&P 500 and a bond. That's the risk that a strong economy can have. The sweet spot is, however, for the market to avoid for the market to move higher from here, we need earnings growth to be faster than the valuation shrink. So the bull case is corporate earnings for 2026 are revised upwards so aggressively that they can offset the fact that interest rates are 5%. The market grows into high prices. The bear case is the no landing scenario, which forces the Fed to increase rates again to prevent the 4.4% growth turning into 5% inflation. Super complicated. I mean, if you wanted to really analyze what's happening today, you'd have to go to university for you'd have to go to university for 4 years, do an economist course, spend 10 years trying to figure out all the little bits. As an investor, the takeaway is stop expecting rate cuts. They're not happening. If rate cuts don't happen, then the bond yields can go higher. You can earn money for free by owning bonds. A strong economy doesn't always mean a bad thing. Yes, you won't get rate cuts, but markets, the companies can earn more money. We want to see inflation go down. That will give more reason for rate cuts to happen. But you just want to simplify it all. We can go down, we can go up, we can go sideways. Be prepared for every scenario. If you have a diversified portfolio, and again, I'm not giving financial advice because everyone's situation is different. But in general, if you have a diversified portfolio, if you're not looking to retire tomorrow, if you're looking to retire, then obviously you're more in bonds. If you're looking for growth, then the portfolio would look like a little bit of gold, a little bit of silver, a little bit of crypto, all world assets, ETFs, low cost indexes, not managed funds because they take away your profits, and bonds. Why would you want bonds? Well, bonds will allow you, if there's a crash in the market, so if you get that, so there's 3 options. There's always 3 options. Boil it down to this. If you get that crash, you've got money on the side, whether it's in money markets, cash, maybe you sell your gold and silver, you've got cash, bonds, whatever on the side to buy that market. If it comes down, so you can take advantage. If it goes up, you're already 70, 80% invested. Brilliant. You're a long-term investor and the market's going to go up over time, whether it's the next year, 3 years down the line, or more likely 5, 10 years down the line, you're going to be higher than you are today in most scenarios. So you want to be invested in case it goes up over the long term because you're a long-term investor, but you also want to have money on the side to take advantage of dips. Those are the 2 scenarios, up or down. And in that situation, you're prepared for the upside and you're prepared for the downside. I personally like to keep up to date with every single thing that's going on. Why? Well, because I want to take advantage of the dips. If this information came out and a certain stock it went down because of it, I would go in and buy that stock. I am a higher risk investor. I am younger, so I can take those risks. And I'm looking at AI. I'm going to start my portfolio challenge on January the 1st, not January the 2nd, because January 1st is bank holiday. January the 2nd, I'll start the portfolio challenge and you'll see how I look at investments. I'm going to actually show you something now about AI in 2026 because I'm still bullish on the markets. I am aware of the risks, the carry trade risk, the bubble risk, the China housing crisis, but I don't want to just be out the market. So I'm going to show you something that I've put together for you guys about the AI in a second, and we can listen into that. It's a story about AI with AI, which is interesting. So we'll look at that in a second. But I want to answer some of your questions. If you have questions now, please leave them in the chat. And then stay with me for sectors that I'm looking at. It's not just your big names. I'm not just looking at Google, Tesla, I don't know, what, Microsoft, Nvidia. I think there's different sectors that are worth exploring and that are going to take advantage of AI. Because if you don't think AI is going to be the next thing, if you think AI is just ChatGPT and a chatbot on your phone and you think it's annoying and you think it's terrible, you need to wake up. AI is going to change the world. In 5 years' time, you're going to look back and go, there was a time before AI and there was a time after AI. And it's going to change the world. So you want to be invested in AI. You want to be aware of AI. Don't just think it's a gimmick. Don't just think it's funny videos online. Don't just think it's annoying because you see weird videos online that look realistic, or don't think it's just terrible chatbots that don't know how to answer questions. It's way more than that. And the investment in AI is absolutely humongous, the highest we've ever seen. So AI is changing the world. 5 years from now, 2 years from now, 3 years from now, the world is not going to be the same place. So you heard it here first. We've been telling you about this for 2, 3, 4 years now. AI is going to change the world, and it's speeding up. Martyn has just said, now looking for, and again, that AI analysis is literally coming up. I'll start in about 4 minutes' time. I've put together something for you guys. Oh, let me just change that. Why is that over there? Normally I go over here. This is what I want. I apologize. Let me take that off the screen. Martyn has said, now looking at profit, now looking for profit on Coca-Cola to start building my crypto position once again. No rush yet. I'll be taking my time and waiting. Thank you, Martyn, for the update. The economy is not the stock market. The economy is not the stock market. The economy is not the stock market. How many times has Martyn said it? How many times have we said it on the show? The economy is not the stock market. If you thought we had massive growth today and we are up 1%, compared to a really strong number we were expecting anyway, 3.3% GDP, and now we're at 4.3% GDP, and you think the economy is brilliant, the stock market, that means the stock market is brilliant. It does not work that way. The economy is not the stock market. Slowly catching a monkey. No Christmas rally. Is the market closed tomorrow? Is the market closed tomorrow? I won't be live tomorrow because I'm going to the doctors. But I think the market's got a half day tomorrow. I think there's a half day tomorrow in the stock market. Rocketing silver. Yeah. What's going on there? We like silver. Follow the money. US, Asia, Europe. Chris F says, what ticker symbol for the 10-year bond iShares 10? I don't know off the top of my head. If you just type that into the internet, 10-year bond iShares 10, 20 year, it will come up. We've got a special guest on the show.
Adralo.1 donated $2 through a super chat. Is Martyn still trading during his situation?
His situation.
Injured face emoji.
I love it. During his situation, is Martyn still trading? I don't even want to picture what that is. What's going on with Martyn? If you guys don't know where Martyn is right now, why he's not live, let me show you this. Is he still trading during his situation? We're wishing Martyn all the best, and we hope nothing gets found. But Martyn is in during his yearly checkup. So yeah, love and support towards Martyn right now because he is at his yearly checkup and he does his yearly show. This year he has a very special thumbnail. Let me zoom in on this. It's time to get your prostate checked. Get your prostate checked and look at the size of that finger. That's Martyn, and he's at the doctor's, and this is his yearly message to everyone. Men, please go and get your prostate checked. I know we're always busy. There's always something going on. We might think we're really tough, but just take a second, book in that appointment with your doctors. It can save your life if it's checked early. If you leave it too late, then it's too late sometimes. But just please, this year might be early. So go and just check, book in an appointment. This is Martyn's yearly message for all the men to go and get your prostate checked. There's already jokes coming in, so I'll send you all to this event after, and you can all start joking in the live chat. This is our yearly prostate event. But anyway, yeah, and it's not just for the men. Everyone should get checked. Women should get checked. There's other places. There's obviously breast cancer is a big one. Please go get that checked. But yeah, we're a show of mainly men, so please. I know you're going to put it off and you don't want to do it and it's discomfort or you don't have the time, but just if there's a message to take away, your health is more important than the stock market. So take a second to book in that doctor's appointment, especially the older you're getting, the more important it is. Okay, let's go back to our chat over here. Uh-oh. Oh, God. Here come the jokes.
A David T9H3L donated $5 through a super chat. Martyn, please don't say hold when your procedure starts if you are trading while it is going on.
Oh, God. Thank you, David, for being a special guest. I'm sure Martyn's enjoying this. I can already see that the live chat on Martyn's show is blowing up already. And you can see behind me over here. Make sure he tickles your tonsils, Martyn says. Slim Jim. Sure hope your doctor has small fingers. The joke's already pouring in. I'll leave that to there. Okay, let me give you my... let me see if I can bring this up. So I ran a little experiment yesterday. Let me see if I can open this up. Trying to bring something up for you. I ran a little... This is where the AI analysis comes in. Can I play this?
Welcome back to the deep dive. Welcome back to the deep dive. Today, welcome back to the deep dive.
Okay, can you guys hear that? Welcome back to Deep Dive. So I'm going to answer some of your questions, and then we're going to come on to this. So I ran a little bit of an experiment yesterday. As you know, I'm starting the portfolio challenge, and my research is starting. What have I done? My research has already begun. AI is going to be the biggest sector. Let's just keep an eye on the market while we're speaking. How's the market reacting right now? Want to see if there's anything moving. No, we're just stalling out. We're down and sideways. So AI is going to be the biggest thing in the world. It already is. Over the next 5 years, the world is going to change. So in that case, surely the stock market should go up and the AI stocks. It doesn't always work out that way. But if I think it's going to be the biggest thing out there, and the last time I thought this big was with XRP, I thought it was going to be massive. It went up from 10 cents to $3, and then more recently it went up from 30 cents to $3.30. The time before, my next biggest investment was Tesla. Tesla was everyone was hating on it. No one really understood it. It went from nowadays after all the stock splits, basically from $5 to $400, or a few dollars to $400. And that's because everyone was shorting it. No one believed in it. The next big thing is AI. And AI is bigger than Tesla. It's bigger than XRP. It's going to change the world. So I want to start seeing how to invest in AI. I did a lot of research. I did deep dives. I did a lot of research. And I put it together in this AI podcast. So I think, so if we listen into this, let me know what you think. Yes, it's not real humans speaking, but it's based off research I've done. So it's based off my inputs. It's not just based off random AI research. So I spent time, an hour or so researching, and then I gave it to this new system by Google, and it turned it into a podcast. So it's easier to listen to, easier to understand. Obviously, people can. I've done all the research. It's only basing off my research, and that's what I wanted. I didn't want it to hallucinate. I didn't want it to come up with some out of date information. I wanted it to base off my research, and it's created this podcast. So what we're going to do is listen into it. It's only about 15 minutes, and it's going to tell you about some of the sectors I'm looking at, and then we can pause it, listen into it. I want you guys to tell me what you think about it. Do you like it? Do you not like it? But this is part of my research. So I did all the research. I listened to it before I went to bed to start thinking. And I thought, actually, if I've done all the research and I've done it, and I think this is pretty good, let me share it with all the Lucasades and get your opinion on it. Right now, Martyn is not doing he's not live right now because he's at the hospital. So let me read some comments and then we'll listen into that. So stay tuned with me. That's it's going to form a big part of my AI research on what sectors. It's not just let me invest in Google. I want to see the underlying what's going to move underneath the surface. Google and silver was flat for 25 years. So good luck if you don't take profits at these prices. Gold and silver was flat for 25 years. Depends how you look at it. But yeah, gold was flat. But I mean, it's not for 2000. Well, it depends what you look. Obviously, it's not flat now. But yeah, from 2010, it was flat to 2020. But that's if you just bought it at the peak of 2010 and didn't sell until 2020. If you actually dollar cost averaged or bought at the bottom or bought throughout that time, you would actually be up. So I don't think your statement's completely correct about 25 years. In fact, it's incorrect.
A Human K donated $1 through a super chat.
Thank you very much for that. I don't know why these two super chats didn't read. Let me read them out. Rallo said, Martyn, don't yell, get in today, save it for later. And David Hensley says, Martyn, can you now say what a Muppet feels like? You can now say what a Muppet feels like. These super chats didn't come in. I apologize. I don't know why that didn't read it out. Maybe I was on the wrong scene. So someone just said 25 years gold and silver has been sideways. Let me just bring up a chart for you. 25 years it's been sideways. So the sideways period was between 2011 and 2020, and it wasn't just sideways, it went down. So if you bought it from the bottom to the peak, you made 80%. So if you're DCAing, you're still making money. But yeah, you can argue the fact that gold and silver was sideways from 2011 to 2022. That you can say it might have been sideways for 10 years, but in fact you could have still made money if you DCA'd. 25 years ago, gold was at 25 years ago, gold was at $263. Currently, it's at $4,467. So I don't think you can say it's gone sideways. If we look at the percentage returns on that, we're looking at from 25 years ago, we're looking at 1,700%. So Gold has certainly not gone sideways for 25 years. And silver, your argument might hold up here a bit better. And that's why I always say I prefer gold compared to silver. But yeah, no, silver, yes, had a massive 2011 short squeeze, came back down to $13. So that, if you want to make the argument of sideways or not buying when it went lower, then that was a period of 13 years. It went sideways, but again, who just buys at a peak and doesn't take profit until it goes higher? There was all this time over here to accumulate at $14, $15, and if you were at that point and you got your average down to, let's say, not all the way at $11, not all the way at $15, but maybe at $18, you'd still be up 280%. And 25 years ago, silver was at $4.60. So $4.60 up to $50, or where we are now at $70, that's 1,000%, 1,300%. So again, thank you for your comment, but it's fundamentally wrong. Martyn said, Sensei is my pimp. He's making money out of this. I love it. PCA blood test, no finger. PCA, no need for finger up the bum, says Don Pileco. Whatever it takes, go and get checked. Sensei, did you say you were starting the 5K portfolio like Martyn? Yeah, I think I am. In fact, I am. Starting, I'm aiming to start on January the 2nd. And my first bit of research I'm going to share with you guys. I turned it into an AI podcast, and I want to see your opinion. AI needs the silver. Yes, it does. James says, Martyn asks, is this really required? The doctor says, relax, it's medically inspired. A cough, a pause, dignity gone. The doctor stuck his finger right up.
A Human K donated $5 through a super chat. If you had little money and could only invest in one AI stock today, which one AI stock would you invest in today?
I don't know yet. I haven't completed my research, but we're going to get a good idea on what sectors in a second. I'm about to play the research I've done. Oh, Brian just booked my finger appointment. Brian, that's amazing. Everyone go book your appointments and let me know in the chat you've done it. Silver and gamma squeeze in progress. Short. Thank you. Gold sits in pallets and vaults. Silver gets used up in tech. Yeah, but gold also about 20% of us used in jewelry, and that's not going to stop. And also people use obviously gold as bullion, but I guess that's what you're saying. SpaceX went public. Is it worth investing in? SpaceX hasn't gone public. Be careful, you might be getting scammed. We've got a new super chat coming in from Huang.
At Hovu 4773 donated 49,000 through a super chat. Happy morning, Uncle Martyn and Sensei. God bless.
God bless you too. Thank you for tuning in. One of our great supporters here on the show today. Big Bear AI. February the 10th is mine. Oh, David Scott is booked in. Leah Guy says, isn't this data good news on risk on and in general? It shows growth and less risk of recession. I think the pump will turn. On surface level, yes, Leah Guy, that's correct. No recession. Is it good for risk on assets? Well, look, the issue is deeper. There's many, many issues with it. You can look at it both ways, but the main issue of it is no rate cuts because the economy is so strong. And if you get no rate cuts, bond yields go up. And if bond yields go up, people will choose to invest in bonds rather than the stock market because they get risk-free returns. That's the main issue you're facing right now. And that's forgetting about how much rate cuts inject liquidity into the market and the fact that this causes inflation, GDP being up, and all this. Look at this.
At Martin Lucas Investor donated $9.99 through a super chat. All this money being made out of me taking it up the bum. I feel violated and abused.
Oh God, there it is. I wish you didn't have to say that, Martyn, but there it is. Guys, keep the money coming in. I think Martyn's enjoying it. All this money being made, taking up the pub. I feel violated and abused. Shall we violate and abuse Martyn a bit more? If you do want to support the show, there's a little button over here, and that little button, even if everyone does $1, press that little button, you can do a super chat, or you can give away memberships. At what age do you start checking your prostate? I think at any age, but let me check Google for you. What age should you check your prostate check? Answer. Isn't a routine? They should consider above the age of 40, the risk increases a lot. So I'd say above the age of 40, definitely after 45. If you're not doing it after the age of 50, most places will do it, like the NHS will do it for free, and in America, I'm sure there's the different ways you can do it. But yeah, over 50, I think you do just have to be doing it. But yeah, over 40, you're high risk, especially if you've got the symptoms. Should we look at the symptoms? If you're over 40 and got these symptoms, so these symptoms are it normally has no symptoms. That's why you have to check. But when they appear, they usually involve unitary changes like frequent. Oh, this is important. Steve donated saying PSA blood test is not 100% accurate. Trust me, I know. So look at that. Someone said you can just go get the blood test. But now we've got first-hand experience saying it's not 100% accurate. So there we go. Keep in mind the finger test will find a lesson. PSA blood testing is best shot. If you must get a finger test, make sure. Yeah, it looks like it's best to go to the doctor and get the proper check rather than the blood test. So, but don't let that put you off. Just go do it once a year, or worst case, do the blood test and do that. So what you need to look out for, most of the time there is no symptoms. You're looking for needing to pee more often, especially at night. Needing to pee more often, especially at night. Difficulty starting or stopping urination. Weak or interrupted urine flow. Feeling like your bladder isn't empty. Urgency or sudden need to go. Pain or burning during urination. That's actually a bit less common. But other early signs are blood and urine, blood and semen, pain or discomfort when sitting, persistent pain in back, hips, pelvis, or bones, unexplained weight loss or loss of appetite, extreme fatigue or weakness, swelling, numbness. Those last ones are quite advanced symptoms, swelling or numbness in legs or feet. So those are your symptoms as well, but most of the time it doesn't show symptoms, so you have to get checked. Here we go. Potato Family is in with a super chat.
At Potato Family 3958 donated $1.99 through a super chat. Hope DR has small little fingers. Texas, everything is big.
There it is. You can continue doing those super chats and keeping Martyn entertained. If you press that button there and you do a super chat, there we go. Miss you so much, Uncle Martyn. Hope your health is being healed every day. Yeah, our thoughts are with Martyn. Obviously, it's always scary for anyone going to the doctors, but hopefully more people will go because of this. Okay, let me play that. Get the scope checked is the best way to check it all out. Okay, there we go. We got some information coming in there. If you have just tuned in, please do hit that like button and subscribe. If you haven't got the newsletter yet, here is the newsletter. Now, what I'm going to play for you, I'm going to explain it one more last time. I did a lot of research. There's this new tool by Google LLM Notebook, which allows your research, only your sources. It doesn't go out and hallucinate. So I've done the research, I put the research in, and it creates it into a podcast. So it's a little bit scary because it's quite realistic, but it's also quite good because it's an easy way to listen to it. So it's put all my research into a podcast, and we're going to listen to it now. It's about 15 minutes long, and it's all about AI and where I'm looking to put my money in. So it's my research, what I've looked at, the important parts I've looked at, the way I'm thinking about it. I looked at it through a lens of people that really know everything about AI, the AI geeks, rather than normal stock market analysts, because this is unprecedented. AI is absolutely unprecedented. You can't just apply all the laws of the stock market, all the laws that analysts used previously to analyze stocks to AI, because it's completely different. The amount of investment is unprecedented. The scale of growth is unprecedented. There's going to be a world before AI and a world after AI, and we're now approaching the world after AI. So we want to look at it in the scope of these AI geeks and where they think it's going, rather than just old normal stock market analyst people, because we're in a different market now. So that's in the scope we're looking at it in. That's how the research was conducted. Now let's play it and give me your thoughts. So here we go. Let me play it.
Dive. Today, we are strapping ourselves in to look at, well, probably the fastest moving financial
Can you guys
concept
hear
on
it?
the planet. We're talking about the future of the markets, but viewed entirely through the lens of AI acceleration.
Right.
And our mission today isn't to just, rehash the same analyst projections. We're kind of done with those old models.
Well, they don't really apply anymore.
Exactly. The goal here is to see where the actual tech fundamentals, the real capability breakthroughs, and this massive capital spending are pushing the financial landscape. We want the AI geek thesis, not the Wall Street guide.
And that's the critical distinction, because the market is really caught in this core conflict right now.
That conflict.
Yeah. On one side, the AI acceleration is absolutely real. It's undeniable. But on the other, the sheer amount of capital, the debt needed to fund it, is, well, it's completely unprecedented. So we're looking for those aha moments.
Brianda Lisandio donated £9.99 through a super chat. Seriously, people get cheek. My brother had prostate cancer 10 years ago, and the finger test saved his life. Fell violated for 10 minutes and lived for years.
Wow, look at that. Thank you, Brian, for raising awareness, guys. First-hand experience once again. Seriously, people get checked. Just go and get checked. If you're 40 and above, 100% go get checked. He says his brother and all those symptoms I read out as well, but you need to get checked. The symptoms are not always showing up for most people. So he says, seriously, people get checked. My brother had prostate cancer 10 years ago, and the finger test saved his life. The finger test saved his life. And he says, you feel violated for 10 minutes, but it saves your life. Think about your loved ones. Think about yourself. You spend all this time researching the stock market, but you don't take a minute to book an appointment. All the guys, please go out and get that check. Let me continue. Yeah, if you've heard this before, guys, people are, this is not real people, this is AI. I'm using it because I'm telling you it's AI. I don't want to deceive anyone, but it's all my research put into it. So be careful if you hear this out other places. They might not be doing good research. At least you guys can trust me. You've seen the research I do in the newsletter. This is my own research being put in. But no, someone's just said in the chat, Kello said, this is crazy. I heard this on someone else's YouTube channel. I thought it was literally two people discussing something. I had no idea it was Google. No, this is Google. But again, the way I've done this, I've given it my research. It's only going off base my sources. But let's continue.
That analysts who are just trained on old earnings models are missing.
Because they can't grasp the speed of it all.
The speed is everything.
And that speed, I think, is the hook for this whole deep dive. The biggest signal that changes everything isn't next quarter's chip sales. It's the collapse of the timeline for AGI.
Artificial general intelligence. If you look at the research community, the people inside DeepMind or OpenAI, their consensus for AGI used to be way out.
Like 2060 or something like that.
Exactly, 2060. Now, the estimates from those same experts are for AGI-like capabilities to arrive somewhere between 2027 and 2029.
Wait, from 2060 to 2027, that's a collapse from 40 years down to maybe 4?
It's a multi-decade compression, and
the scale of the growth in AI is unprecedented. This is not what we're expecting. This is not what anyone was expecting, but it is rapidly growing, and that's why I think it's going to be a big part of the stock market. That's why the stock market has been growing. But I'm looking at underlying investments, and in this podcast, you can explore what parts of AI I am looking at. We'll get onto that later on in the podcast. Again, this is an AI podcast, but it's done with my deep research. It's a way I just want to grasp your opinion on it. So you can see if you like it. Share this post on X. I'm paying you $2,000 to embarrass me. You win tickets. Oh, you win tickets. There it is. Martyn has just posted an X post. Do click on that, repost it. I'll leave that link there so you guys can click on it.
that speed is even remotely accurate, then any traditional 5-year earnings model you see is just fundamentally broken. It can't process that kind of exponential shock.
Okay, let's unpack that. Because if this is so transformative, so exponential,
David Hensley 3009 donated $2 through a super chat. Prostate exam gives a new meaning to the doctor is in.
There it is. Thank you, David Hensley. I love it.
why are so many people still screaming bubble? We have to compare today to the 2000.com crash.
And it's a fascinating comparison because the market today is simultaneously...
So here's our first point of the podcast. We're now looking at let's compare it to a 2000 bubble. Is it the same situation? A lot of people remember these old analysts, which I don't really want to trust right now because they're too old. They're set in stone. They think AI is the same way you value any company. One way we're looking at it is let's compare it to the 2000 bubble. That's one argument we have. What does that hold up, or is it wrong?
Much, much stronger than in 2000, but it also carries a risk that's in some ways even bigger.
Bigger? How so?
Well, let's start with the basics, the financial anchors. In March 2000, the Nasdaq's forward PE ratio was insane. It hit 60.1 times.
60 times? So you're paying $60 for every $1 of expected future earnings.
Pure speculation. Today, that same ratio is around 26 times. So yes, it's stretched, but it's not even in the same universe as the dot-com extremes.
And the user base is completely different.
Oh, completely. In 2000, the internet had, what, 361 million users?
Yeah.
I've got a lot of questions coming in about the market open. So yeah, we'll be covering the market open. That's in about 10 minutes time. Martyn is at the doctor's. I don't know if he'll be, I don't think he'll be making it back from market open. So we'll be covering it. His stream has started. We'll be back in about 3.5 hours. But yeah, we'll be covering the market open. So don't worry about that. Flippio, no, you've got this completely wrong. This isn't just AI research. This is my research put into an AI model that's created the podcast, so it's easier to understand my research.
About 6% of the world, AI is being built for billions of people who are already online, already digital.
And crucially, the companies leading the charge are actually making money. A lot of it.
That's the biggest difference. The Magnificent Seven, which make up a wild 67% of the S&P 500's market cap, are projected to grow earnings by almost 30% in 2026.
The dot-com companies had no earnings. They just had a business plan and a cool name.
They were valued on dreams.
Yeah.
But you ask where the risk is. If earnings are real and valuations aren't extreme, where is that systemic danger hiding?
Yeah, where is it?
It's hiding in the capital requirement,
Uh-huh.
specifically in the debt market.
Not the stock market.
No. The dot-com boom was funded by billions in speculative equity. This AI boom requires trillions in leveraged debt to build the actual physical infrastructure.
Trillions.
Wall Street is projecting $900 billion in new tech debt for 2026 alone. The cumulative number could be as high as $1.5 trillion over the next few years.
And that's coming from who?
The hyperscalers, Meta, Microsoft, Alphabet, Amazon, they are borrowing on a scale that dwarfs anything from that previous era.
So the risk isn't that investors lose their stock investment. It's that...
I think it's very different to 2000. 2000 was very speculative. I'm not saying AI isn't speculative. I'm not saying companies are not going to go bust. But AI is completely different to the internet. It is even more revolutionary than the internet. And imagine how revolutionary the internet was. AI is going to be even more revolutionary than the internet. In 5 years' time, we're going to look back and go, the world is such a different place. And that requires a lot of investment. And that's what they're doing. But they are taking out a lot of debt. They are issuing bonds to put up that investment because they need to invest in data centers. As we go on through this piece I've created for you, we're going to look at the specific sectors I might be investing in for the portfolio challenge. We're looking at maybe manufacturing robots, energy utilities, because those will go up because the amount of energy needed for this, data centers, nuclear fusion reactors, all of this is needed for AI. And I'll be able to de-risk from specific stock investments in case some big companies go bust over this. So that's what we're exploring. We're 5 minutes away from a market open. Okay, let me continue. Let me see if I can put this. We'll be covering the market open, so stay with us.
These giants can't pay back their loans.
Exactly. If the AI revenue doesn't show up fast enough to service that $1.5 trillion in debt, that's the new systemic concern. And it's all concentrated in just 7 companies.
That really...
Yeah, this is the issue. There is a risk to all of this as well. Trillions of dollars of bonds have been created. Essentially, debt has been issued by these Magnificent Seven to build all this. If the return on investment isn't quick enough, we can have some major that's a major systematic risk in the market. We can have a major downturn. We can have one of these big 7 potentially I mean, worst case scenario, you can have one of them go bust. And obviously, they'll be say, I mean, we're not going to see them go bust, but we can basically see them drop 50, 60, 78% down if they start defaulting on any of their loans. That's a possibility. How much percentage do I assign to that? Maybe 10, 15%, but it's still a possibility. The amount of debt being issued by them, and if they can't prove the money, if they can't pay back that loan, then we have a big issue. That's a big systematic risk we have.
Clarifies the high wire act here. The market is basically assuming that this massive capex spend, what's the number? Over 500 billion for 2026.
$527 billion projected, yeah.
All of that will be captured by the Mag 7 and it'll all work out. But the first sign of trouble would have to be in their cash flow, right?
Absolutely. And you can already see the cracks forming on the balance sheets. Just look at Meta.
Their spending is huge.
Management guided that their 2026 capital expenditure will be notably larger, which implies something like $103 to $110 billion.
And what does that do to their actual cash?
It's expected to plummet. Free cash flow is projected to fall by 50%, from over $37 billion.
Let me get ready for the market open. We're 3 minutes away from the market open now. We're 3 minutes away. We're going to cover the market open and then go over to Martyn's event. Let me, and then I'll bring you all that research later. I've just got something coming in. AI, let me answer some of these questions. AI needs fusion reactors to meet power demands. Truth Social just invested in fusion reactors for a really good reason. Yeah, I mean, this AI demand is going to be absolutely massive. The amount of energy we need is probably about 100 times we have right now. So what we're looking at is potential AI, potential nuclear fusion reactors as investment. We're looking at power grid as investment. We're looking at power plants. We're looking at solar. We're looking at wind. We're looking at all of these as potential investment opportunities. It's not just the Magnificent Seven. The Magnificent Seven currently is performing the best, but is it going to continue to perform the best? We don't know. Are you going to cover GDP as well? We have covered GDP, Anthony. Anthony, we have covered PCE and GDP. GDP was 1% higher than expected. PCE was as expectation. Let me answer some more questions. Also, in 2001 bubble, everyone had money, not just the top 10% of rich people. Yeah, the spread of wealth was much more in 2000. That's right, Songs to Space. Invest in solar panels. That is something I'll be looking at. There is a lot more research I want to bring to you, but I can't right now. Ask AI if it's having power problems preventing scaling to meet earnings prediction. I won't be asked. Look, AI is very, I mean, it's incredible, but for the current AI we have, you can't base your research off it. You cannot just go to ChatGPT or Gemini or Grok and just say, tell me all about this. Surface level information, it's great. But me, as running a media company, as running a newsletter, I know firsthand you cannot just use AI to do research for you. Firstly, it's 1 year out of date, whichever one you look at. They don't have up-to-date research. Secondly, they hallucinate. It's not great. Thirdly, you won't get the deep research. So it's a great tool if you've got the information and you're trying to put something together, or you're trying to format something, or if you're trying to make it write an email, or give it something and ask for it to read through a manual for your washing machine and tell you how to sort this out. However, for a tool to go out and get proper research and based investment decisions off it, it's awful. It hallucinates. It doesn't know how to do deep research. Maybe I imagine in 3 years' time, 5 years' time, it can do it. But right now, it's more of a surface level tool. That's why, for example, with this thing I'm playing for you right now, I didn't just tell it to go and research AI and what's the best investment, because it will come out with some absolute nonsense and garbage. I did 2 hours of research. I gave it to it and I said, and it turns it into a podcast. It's a new tool from the best AI, which is from Google. So it's not hallucinating because it's only taking my information in. Ring the bell, ring the bell. It's the bell now. Okay, let's ring the bell. Okay, let's go through it. But yeah, that's how we do it differently here. We don't just use AI We're ringing the bell. Let's go through the market. Bloomberg is now covering the morning.
Novo Nordisk
I can't
surging.
believe
You know
this.
why? The FDA approved the sale of a pill
At
version
Cormonter
of
Richmond has
Wegovy.
become a member.
Novo
Bell
can
and
start
Phoenix.
selling the pills in the US as early as next month.
Okay, the bell has gone.
1991.
Let's get
Birds
ready
and people
to
are living
rumble.
together in seemingly perfect harmony until one day a young man catches fire. This is Phoenix.
Amazon up. We've got Amazon up 0.98%. We've got Tesla up 0.5%. Let me turn this down a little bit. We've got Nasdaq up 0.46%. We've got Vivo Power up 0.4%. Google flat on the day. Palantir up slightly on the day. Microsoft up 0.4%. Nvidia, we've got up 0.05%. Where is Nvidia today? Nvidia is at $184. Looks like it's peaked. Berkshire Hathaway flat on the day. PayPal up 0.3%. Netflix up 0.42%. Disney up 0.25%. The S&P 500 is flat after that shock live PCE and GDP data. S&P 500 flat. Meta up slightly. Dollar Tree up slightly. Apple down 0.5%. I'm not looking at the Magnificent 7 right now. AMD down 0.37%. Alibaba down 0.5%. GME down 0.5%. Coca-Cola down 0.4%. I'm not looking at Coca-Cola right now. Russell is down 0.3%. Wrap is down 0.45%. Lyft is down 0.73%. Archer is down 1.43%. It's actually back at support. Archer is back at support. SBC down 2 points. We've got SBC down 2%. It's approaching a level I might be interested in. ARK Invest down 1%. Tilray down 2%. Absolutely awful performance from Tilray. iBit down 0.88%. Rivian down 0.43%. AMC down 1.18%. Enphase Energy down 0.81%. McDonald's down 1.35%. Snapchat down 1.8%. MicroStrategy down 1.8%. J&J down 1.65%. Wouldn't be touching it with a barge pole. Joby is down 1.5%. Soundhound AI down 1.33%. Coinbase down 1.38%. Vertical Aerospace down 1.58%. Robinhood down 1.77%. Won't be touching it. Rocket Lab down 0.64%. Circle down 3.28%. Luna down 3.24%. Weto down 7.56%. Mobix down 2%. There we go. And what's the crypto market doing? Crypto is also down. If we go over here to our... This is the Nasdaq right now. Let's go to crypto. Why is that? Is that Bear with me. Let me see if this is updated. Yeah, there we go. 24-hour change on Bitcoin is negative 2%. Here is on the 1 day on the S&P 500. We are down, mostly green, slightly green, and the Nasdaq as well. Okay, let me go over to your live chat and then we'll end the show. Let me know if you want me to continue with the AI analysis. Otherwise, we can end the show and go over to Martyn. Tech needs silver. Yeah, we're very bullish on silver. Silver smash now, backfire in the hold. Do you think will silver smash hold? Coca-Cola dumping, says Richard. James, big caps up, small caps down, says DJ Haynes. Amazon says human being Liz. Maybe AI, but at least AI Asian guy is honest. Don't know what you mean by that. Lol James says Mike, agree, not reliable. Yeah, it's not. That's why it really annoys me when someone says our newsletter's AI. I wish it was. It would save me 5 hours a day. Maybe in 5 years' time it can be, and it'll be just as good, and it doesn't matter. But I want to give you the best content. Anyway, finally, Amazon back a bit. Red Day Tuesday sales incoming. Okay, thank you, everyone, for tuning in. I'm just going to set this up so it goes over to Martyn's show. Remember, Martyn is at the doctor's right now. He'll be live in a couple hours time. So we'll go over there and we can make some jokes in the comment section there. Unfortunately, I can't continue because I'm can't. Okay, there we go. Yeah, you guys want me to continue. I just need to get confirmation that I can continue. Let me see. Let me see if we can get. Otherwise, we will end the show. Yeah, that's the we've gone through the stocks on my watch list. As I said, 2nd of January, hopefully I can be starting that portfolio challenge, and then we can start researching each topic in more detail. I'll be starting with the research of what platform we're going to use, then it's going to be what bonds we're going to buy, and then we're going to be looking at the investments that might come our way. But yeah, that's how it's going to start. So do tune out for that. If you haven't got the newsletter yet, there is the 1 week free trial. Okay. Thank you everyone for tuning in. Until next time, end of year sale, says Ninja. I love it. Until yeah, this is the last trading day. I won't be live tomorrow. If you don't see me until after Christmas, I wish everyone a Merry Christmas. Thank you everyone for all the support during this year. This is the year I quit my job and came for you guys, came to support you guys full time. Thank you everyone for supporting me throughout that journey. And I am not going to be live tomorrow because we're going to doctors. So I wish everyone a Merry Christmas. Don't forget to get a Christmas mug on martynlucasshop.com. I apologize, I can't continue with that right now. So until next time, take care of yourselves and each other. We'll go over to Martyn's stream now. Bye-bye.